Chapter 9 deals with stocks and how to value stocks. The major objectives for this chapter are to discuss the legal rights of stockholders, explain the difference between a stock's price and its intrinsic value, identify the two models that can be used to estimate a stock's intrinsic value. The first one is the discounted dividend model, and the second one is the corporate valuation model. And then finally, we want to be able to list the key characteristics of preferred stock and describe how to estimate the value of preferred stock. So, common stockholders, like if you bought a common share of AT&T stock, you would be considered a common stockholder. These common stockholders are the owners of a corporation, and because of that, they have certain rights and privileges that are mentioned in the bullet points. Well, first, ownership implies control. So a firm's common stockholders have the right to elect its firm's directors, who in turn elect the officers who manage the business. Now, in reality, if you own like 5 shares of AT&T stock, you really don't have much control over the firm at all. Because it's such a small percentage, the votes that you cast are not going to really make a big difference. So, the major institutional investors in the firm actually, when they vote, they're the ones who have like maybe 51% of the voting rights, and so whatever they decide and they vote on, that's what occurs. And then common stockholders often have the right, called the preemptive right, to purchase any additional shares sold by the firm. So if the firm is going to offer a new share issuance into the market, it can allow, or it should allow, if the shareholders have this preemptive right, they should be able to purchase a percentage of the new issuance so that they can maintain their same ownership percentage in the firm. In some states, this preemptive right is automatically included in every corporate charter, and in others, it's necessary to have to insert it specifically into the charter. And then the goal for management, and this is a key thing to remember for this class, is to maximize the stock price. So what we'll see later on when we calculate the net present value of a project, we're trying to accept projects that add value to the firm, because the overall goal of management should be to maximize the share price. And that means when you look out on Yahoo Finance, that you see the stock price going up because the managers are taking on good projects that have positive net present values that are increasing the value of the firm. So this is very important. So the stock price is what you see out in the marketplace when you look on Bloomberg or Yahoo Finance. And the intrinsic value could be something totally different than what you see in the marketplace. So the intrinsic value is basically what I, as an investment analyst, would calculate to be the correct price of the stock. And this chapter shows us tools to learn how to calculate the intrinsic value. So since we don't have insight into what's going on inside the company, we don't work there every day, we don't hear rumors, we aren't in important meetings that they have. We, as outsiders, are trying to figure out what should the true value of the price be. And this next chart illustrates what I'm saying. So the stock's market price is based on, that's just what you're going to see out in the market. And it's based on perceived investor cash flows and perceived risk. Now, the intrinsic value is what is really, really true about the firm. So what's really happening? What's the true expectation for investor cash flows and the true risk? And really only the insiders to that company know this. But we take a guess at that and we calculate stock price intrinsic values. And then we compare that to the stock market's price. And so before, we see that a stock with a price below its intrinsic value is considered undervalued. So if I calculate a price for ExxonMobil and I calculate that it's $35, it should be worth $35, but in the market it's selling for $25, then I know that's a good buy and it's undervalued. I should buy it now and then wait for it to rise up to its new $35 value, the intrinsic value that it should be worth. And then if the stock price is above, let's say the stock price for ExxonMobil was $45, but its intrinsic value was $35, then I would want to avoid that stock, because if the intrinsic value is 35, the stock price in the market of 45 should drop down to 35 over time to represent that intrinsic value. So you would lose money on that investment. So you lose money on overvalued stocks, but you can make money on undervalued stocks. And that's really the whole goal of this chapter. Is if you look out at investment analysts' recommendations, they're saying this stock is undervalued, buy it, or this stock is overvalued, they'll say sell it, or they'll say this stock is pretty fairly valued, so you can hold the stock. And there are lots of investment sources like Value Line that you can look at and see what is somebody's opinion in terms of the stock, and someone who's really been analyzing the stock and the stocks, that company's environment that they operate in, and special news about that company. You can read up on that. So back to this slide, if the two prices are equal, if the intrinsic value is equal to the stock price, I calculate $35 for ExxonMobil, and then I look at Yahoo Finance and it's selling for $35, then that's said to be a state of market equilibrium. And that's kind of rare, but that's what we would call it.